Is it possible that the stock market is overvalued? Yes, if we look at the actions and warnings of investors like Warren Buffett. He's been claiming for years that the market is massively overvalued, and many people believe that a crash would solve the problem, but it only exacerbated it, though this cannot be stated for all underlying sectors. Hello and welcome back to the Finance Guardian channel. In February of 2021, the S&P/TSX Composite Index hit a pre-pandemic high. Following the market meltdown, stock markets across the US, particularly the Nasdaq, have skyrocketed. The Nasdaq index has increased by 37% since its pre-pandemic high. If the stock market in the United States was overpriced even before the market crisis, it may now be termed a bubble about to burst, according to Buffett. Although the situation isn't as terrible here, the market can be considered expensive due to the weak underlying economy. When investing in an inflated stock market, there are a few factors to bear in mind. Let's take a look at what Warren Buffett has said on how to invest when stocks are overpriced. Buffett's investment philosophy. You need to remember that investing is a challenging process that requires patience and composure. Making impulsive decisions can lead to regrets in the future. In order to construct an effective investment strategy, you should sit down, take a deep breath, and think rationally. A successful investment depends on two things: experience and advice from experts. Research and gather necessary knowledge about what the market experts are doing and how they plan to invest before you begin your investment journey. The investment philosophy of Warren Buffett is to invest in the business and not in price. He is always on the lookout for stock prices that are below their intrinsic value. At the same time, he focuses on quality stocks, choosing those that have the potential to create value. His focus on increasing his cash pile has enabled him to increase his personal wealth exponentially, from $45 billion in 2008 to $140 billion in 2021, according to industry experts. Taking a long-term approach to investing is possibly one of the most fundamental ideas of all. Rather than considering what would be a successful investment in a few months or years, investors should think about which investments will provide strong returns over the following few decades. People that take a long-term view of assets are less concerned by short-term market fluctuations. Be wise about investment opportunities. When the real estate sector experienced some difficulties, it put a discount on good companies like Killam Apartment REIT. The share price back then is about 23% lower than its pre-pandemic high, and it has remained nearly unchanged since the market meltdown. It has a price-to-book ratio of 1:1 and a price-to-earnings ratio of 8:3, but has also been gradually increasing dividends for the previous years with a payout ratio of 31.4%. The 3.73% yield may be low in comparison to some of the other REITs, but it's not the only reason to consider Killam. It was also one of the most consistent growth stocks in the category prior to the catastrophe. The company's excellent balance sheet and steadily expanding revenues indicate that it is on the right track. According to Warren Buffett's advice to invest in profitable firms and the stock will follow, Killam has a good chance of resuming its pre-pandemic growth and delivering exceptional long-term returns. It's crucial to note that not every undervalued company isn't worth investing in. Take, for example, the energy sector. Buying inexpensive energy stocks that have great records might not be in line with Buffett's approach to value investing. One thing we should never do, according to Warren Buffett, is buy a stock only because we think its price will rise. This is due to the fact that even the most experienced investors are unable to foretell how the market will behave. According to Buffett, you should invest in companies that you both understand and believe will provide long-term value. Write down your thoughts. Buffett told Becky Quick on CNBC's Squawk Box that no matter how much or how little you're buying, you should be able to write your thoughts down on paper without relying on outside resources. He also doesn't believe investors need to be concerned about the stock's performance in the near future. You can have a separate piece of paper if you want to predict what the stock price will do, he said. Rather, Buffett advises concentrating on companies that will maintain their worth over time. People believe that investing in stocks is different from investing in a business because they can make decisions every second, as opposed to investing in a tangible thing like a store or a farm. However, this isn't the case. Buffett follows 3 general rules when deciding which companies to invest in. First, they must earn good returns on the net tangible capital required in their operation. Second, they must be run by able and honest managers. Finally, they must be available at a sensible price. With that being said, any single stock can outperform or underperform, and previous performance does not guarantee future outcomes. Beginner investors should instead consider low-cost index funds, which are far less hazardous. Focus on the long term. If you ask Warren Buffett how today's news will affect the stock market, whether it's the coronavirus outbreak or the tariff situation, he'll most likely say he's unconcerned. This is due to Buffett's refusal to be swayed by headlines while making financial decisions. Instead, he's focused on the long term. The real question is, where are these businesses going to be 5, 10, and 20 years from now, he said. Some of them will make a splash, while others will fade away. With this in mind, Buffett avoids speculating on how current events may affect the market. He stated, "I don't think I can make money by predicting what will happen next week or next month. I believe I can profit by anticipating what will happen in the next 10 years." When Warren Buffett invests in a firm, he has no intention of selling it soon. In 1972, he bought See's Candies with long-standing business partner Charlie Munger, and in 1988, he spent more than $1 billion on Coca-Cola shares, both of which proved to be successful long-term investments that he still holds today. While Buffett acknowledges that the stock market is a little softer than it was more than 2 years ago, and that events such as the coronavirus and Trump's trade war have impacted a number of his companies, he also says that business is down, but it's down from a very good level. Don't panic and sell even if the market is falling, Buffett said. Stick to your guns and stick to your original idea. If you have a long-term investment strategy, you will have plenty of time to recover from any dips in your portfolio. Buffett told CNBC that, quote, "The money is made in investments by investing and owning good firms for lengthy periods of time." He also regularly advises against picking individual equities in favor of low-cost index funds. He told CNBC's On the Money that the secret is not to pick the correct firm. The trick is to buy all of the big firms in the S&P 500 on a consistent basis. How does Buffett's strategy work? Market prices were very high in 2006 and 2007. Buffett had a hard time finding deals, so he kept his money in short-term treasury bonds, which are the same as cash. With Berkshire, Buffett had $45 billion of cash on hand in 2007. In 2008, the great financial crisis struck and stocks collapsed. At that point, Buffett bought stocks at a frantic pace. The cash pile had fallen to $24 billion by 2009, almost half of what it had been in 2007. Mr. Buffett is among the most patient investors around. When he can't find a bargain, he's prepared to let his cash pile build up until a reasonable offer comes along. As he stated in one of his interviews, he used to try shorting stocks when they were clearly overvalued. Ultimately, it didn't work out for him. Even if stocks are clearly overpriced, you never know how long they will last. The shorts failed. As Buffett said, it's time to make money shorting stocks. In times of overpriced markets, he likes to look for those sectors that may offer some opportunities. During the past year, we have seen Buffett make some purchases. He invested in financial stocks like Aon plc and MMC, telecom services like Verizon and T-Mobile, consumer stocks like RH and Kroger, and medical stocks like AbbVie, Maersk, and Bristol-Myers Squibb. So there are sectors that still have some opportunity out there, and just like Buffett, you should be prepared for it. Almost every day, he's in his office reading reports, scanning through stocks, and looking for deals. A few have been found, but not many. As a result, he's still accumulating cash and waiting for opportunities to surface. And that is all the time that we have today, folks. We hope you enjoyed this one, and if you did, please remember to hit that like button. If you're new around here, welcome, and please do subscribe to our channel on your way out. Please do remember to click on that bell icon too, so you can remain updated about all of our future videos. You're welcome to the channel where you will learn the basics of personal finance in easy to understand language. We'll see you next time.